Let's stop pretending. You see the headlines every single day. World War III risk. Global economy on the edge. Markets braced for chaos. Most people scroll past them. They think it's just noise. Cable news filling airtime. Twitter fighting for attention. They think if they just ignore it, it will go away. They are wrong. And if you treat what's happening right now like just another news cycle, it will cost you. Not in 10 years, not in 5, potentially in the next 18 months. I'm not sitting here to scare you. Fear is cheap. Every YouTuber, every TikTok guru, every newsletter in your inbox is selling fear right now. I'm here to translate the fear into something your portfolio can actually understand. I'm Jamie Dimon. I've been in this game for over 4 decades. I've seen crashes, I've seen recoveries, I've seen panics that wiped out good people simply because they didn't see what was coming. And right now, we are looking at a confluence of events I haven't seen in all that time, not even in 2008. 2008 was a financial heart attack. We knew the plumbing was clogged. We knew the banks were over-leveraged. We could see the problem. This time is different. This time we have a hot war in Europe that keeps threatening to boil over. We have a brewing powder keg in the South China Sea that could change global trade overnight. We have the highest levels of peacetime debt in human history strapped to every major economy on earth. And we have central banks playing a game they've never played before, trying to fight inflation without triggering a depression, while governments keep spending money they don't have. This isn't a prediction of Armageddon. I'm not here to tell you the world is ending, but I am here to tell you that the old playbook is dead. The strategy of buy the dip and forget about it for 20 years is a relic of a different world. A world where globalization meant everything got cheaper and every crisis got smoothed over. That world is gone. What's replacing it is something harder, something more volatile, and something that will separate those who understand the game from those who are just along for the ride. Right now, the global economic engine is throwing a rod, and the spare parts aren't sitting on a shelf somewhere. The spare parts are geopolitical leverage. They are energy security. They are control over critical minerals and shipping lanes and the digital infrastructure that runs your life. If you don't understand that, you're trading blind. And if you are thinking about starting to trade, if you're sitting there wondering how to break in, wondering how to get your financial life off the ground in a world that feels like it's on fire, you need to hear this more than anyone. Because here's the thing they don't tell you. The beginners, the ones just finding their way, they have an advantage right now. They don't have bad habits to unlearn. They don't have a mental model built on a world that no longer exists. They can build their foundation on reality instead of nostalgia, but only if they get the map first. That's what this channel is for. That's why I'm here talking to you like this. Not to sell you something, not to give you a ticker symbol and tell you to go get rich, but to give you the framework, the lens, the way of seeing the world that separates the survivors from the casualties in every financial cycle. If what I just said resonates with you, if you feel that nagging feeling in your gut that the ground isn't as solid as it used to be, then you need a source of truth, not opinion, not hype, not someone screaming at you to buy their course, just logic, just strategy, just a clear-eyed view of what's actually happening. That's what we build here on Dimonomics. Hit the subscribe button right now. I'm not asking for a favor. I'm telling you that your future self, the one who navigates the next 5 years without getting wiped out, the one who sleeps soundly while others are panicking, that version of you will thank you for this one click. Do it now. Let's get to work. Let me take you inside how I actually see this. As CEO of JPMorgan Chase, I sit in a room where I can watch the plumbing of the global economy. I see where the money flows. I see where it gets stuck. I see the pipes that are rusting and the ones that are about to burst. For 30 years, the entire world optimized for one thing: efficiency. Get the cheapest labor, the cheapest materials, the fastest shipping. Move production anywhere, move capital everywhere. Borders were just lines on a map. That era is over. Now nations are optimizing for security. They are asking different questions, not how do we make this cheaper, but how do we make sure we still have this if the shipping lanes get closed? Not how do we maximize profit, but how do we make sure we aren't dependent on someone who might become an enemy? That shift, that fundamental rewiring of how the global economy works is more disruptive than any single conflict you see on the news. The war in Ukraine is terrible. The tensions in the Taiwan Strait are dangerous. But those are symptoms. The disease is the breakdown of trust between the world's largest economies. And when trust breaks, everything reprices. I made mistakes when I was young. I thought geopolitics was something that happened over there in some other world while I was focused on my little corner of finance. In the late 1980s, I was deep in the weeds on deals, on clients, on the day-to-day. I ignored the early signs of the savings and loan crisis because I thought it was a regional problem, a niche issue, something that didn't touch my world. I learned the hard way. The tide doesn't care about your sandcastle. When the tide goes out, every sandcastle gets washed away, no matter how well you built it. Today, the tide is going out because of these global tensions. You have to see the tide. You have to see the water receding. You can't just stare at your castle and hope. So what breaks first? Everyone looks at the stock market. They watch the S&P 500 like it's the only scoreboard. But the stock market is just the final destination. The real action, the real danger is upstream. It won't be the stock market you see on TV that cracks first. It will be something far more fundamental, something that touches every single one of you watching this, whether you're trading millions or just starting with your first $100. We'll get to that in a moment because understanding that one thing is the key to understanding everything else. Think about the dominoes. Sanctions get imposed. That speeds up the search for alternatives to the dollar. That creates currency volatility. That makes imports more expensive, which fuels inflation. Inflation forces central banks to keep rates higher for longer. Higher rates make debt more expensive, which strains governments, corporations, and households. And all of this happens while supply chains are being physically ripped apart and rebuilt along political lines instead of economic ones. When I sit with other central bank heads, when we talk privately, the word you hear most often now is resilience. That's the new buzzword. But it's code. It's code for we are preparing for a world without just-in-time delivery from our geopolitical rivals. It's code for we are stockpiling what we can and planning for shortages. And when the people running the global financial system are thinking about resilience instead of growth, that changes everything. If I were sitting where you are right now, a beginner trying to figure out how to start, or a professional wondering if your strategy still works, my biggest enemy wouldn't be the market. It wouldn't be inflation or interest rates or some foreign leader making threats. My biggest enemy would be my own psychology, the fear of missing out, the urge to chase a rally because you see green candles and everyone on social media is bragging about their gains. That fear is more dangerous than any market downturn. I've seen it destroy traders smarter than me. They chase the news spike, they buy the hype, and then the story changes and they're left holding something nobody wants. Don't let that be you. The game is changing. You have to change with it. I asked you what breaks first. Everyone assumes it's the stock market. The Dow drops 2,000 points. CNBC goes crazy. That's the crisis, right? Wrong. That's the ambulance showing up. That's not the accident. The accident happens somewhere else, somewhere most people never look. What breaks first, what's already cracking beneath our feet, is trust. Specifically, trust in the thing we've been told for generations is the safest place on earth, the risk-free asset, government bonds. For your entire life, probably for your parents' entire lives, we've treated certain government debt as the absolute bedrock of the financial system. You buy a treasury bond, you know you're getting paid back. That's the deal. That's the foundation every other asset is built on. Stocks get priced relative to bonds. Mortgages get priced relative to bonds. Everything, and I mean everything, traces back to that assumption of safety. That bedrock is now being stressed in ways most people don't see and won't understand until it's too late. As a CEO, part of my job is to stress test the bank against scenarios that seem impossible. We literally run models that ask, what happens if this breaks? What happens if that collapses? One of the scenarios we take very seriously is a crisis in the government bond markets. Not a default necessarily, though that's in the realm of possibility for some countries, but a crisis of confidence, a moment when the buyers step back and say, the price isn't right for the risk anymore. If that foundation cracks, if the thing everyone relies on as the ultimate safe haven starts to wobble, then every single asset in your portfolio gets repriced. Your tech stocks, your crypto, your real estate, your retirement account, everything. And it doesn't happen over months. It happens in days, sometimes hours. I'm not saying this to make you panic. I'm saying this because you need to understand the game you're actually playing. Most people think they're playing a game of pick the right stock or time the market correctly. That's checkers. The real game, the one the professionals are playing, is chess. It's about understanding the relationships between assets, the hidden dependencies, the things that don't move until they all move at once. If I were managing my own family's wealth right now, and I am, by the way, I don't ask different questions than I'm telling you to ask, I wouldn't be focused on what to buy to get rich. That's a sucker's question right now. The market isn't rewarding risk-taking the way it did 5 years ago. The tide is different. The smart question, the question that protects you whether you're a beginner with $500 or a professional with $5 million, is this: what is my fortress? What part of my financial life is built to withstand a storm? For me, that means looking at quality. High quality, short duration bonds that give me yield without locking me into bets on where interest rates go for the next decade. It means looking at sectors that are essential, not discretionary. Energy, food, defense, infrastructure, the things people need when times get hard, not the things they want when times are good. It means asking hard questions about my own income. Does my job rely on a global supply chain that might not exist in 2 years? Does my business depend on customers who are about to get squeezed from every direction? You have to ask these questions now, not when the crisis is on top of you. When the storm is already hitting, it's too late to build the shelter. You build the shelter in July so you have somewhere to go in December. July is right now. But here's where it gets tricky. Here's the trap that catches almost everyone, especially the beginners who are just finding their footing. The biggest mistake you can make right now, the thing that feels smart but is actually devastating, is to sell everything and hide in cash. I know it sounds logical. The world is uncertain. Headlines are scary. Let me just pull everything out, sit on the sidelines, wait for the dust to settle. Safe, right? Wrong. It's one of the riskiest moves you can make. Because if you do that, if you go all to cash, you are making a massive bet. You are betting against the collective power of every government and every central bank on earth. You are betting that they will just stand there and watch the system collapse. And that is a bet I have never seen the average person win. Governments hate collapse. Central banks hate deflation. They have tools, lots of tools, and they will use them. They will print money. They will backstop markets. They will do whatever it takes, and I mean whatever, to prevent a total meltdown. If you're in cash, when they start those engines, you're not safe. You're getting run over. Your purchasing power gets eaten alive while you watch. When I was starting out in this business, I thought safety meant doing nothing. I thought if I just parked everything in the bank and didn't touch it, I was protected. It cost me. It cost me years of growth. I watched inflation slowly chew away at what I'd saved while the people who stayed invested, who owned pieces of real businesses, saw their wealth grow. Not because they were smarter, because they understood that cash is not a long-term strategy. Cash is a tool. It's for liquidity, for emergencies, for opportunities. It is not a permanent home for your wealth. Right now, doing nothing means watching your purchasing power get destroyed even if your account balance stays the same. Inflation is a hidden tax. You don't see it happening, but every month your dollar buys a little less gas, a little less food, a little less rent. Over time, that adds up to real losses. You have to be an owner. You have to own a piece of the companies that provide the things people actually need, not the things they want when times are good, the things they cannot live without when times are bad. This is where beginners often go wrong. They see the complexity of the market and they think the answer is more complexity, options, leverage, futures, exotic instruments they barely understand. They see it as a shortcut, a way to get rich fast because the world is moving fast. Let me tell you something from 40 years of running one of the most complex financial institutions on the planet. Simplicity wins in a crisis. The most sophisticated thing you can do, the thing that separates the professionals from the amateurs, is understand your own risk, not the market's risk, your risk. What happens to your portfolio if the dollar strengthens dramatically? What if it weakens? What if energy prices double? What if they get cut in half? What if your industry gets hit by tariffs? What if your company can't get the parts it needs? Most people cannot answer these questions about their own financial lives. They know what they own, but they don't know how it behaves under stress. That's like driving a car and having no idea what happens when you hit the brakes. You have to fix that before you buy another stock, before you make another trade, before you do anything else. Know your risk, map your dependencies, build your fortress, because the ground is shifting and the only way to stand firm is to know exactly where your feet are planted. I just told you hiding in cash is a trap. So what's the alternative? What do you actually do with your money when the ground is shaking and every headline feels like a countdown? You build a portfolio that is diversified in a way that actually matters, not the way the brochures tell you, not 50 different tech ETFs that all own the same 50 stocks. That's not diversification. That's just buying the same story 50 times and hoping it has a happy ending. Real diversification means owning things that behave differently under the same conditions, things that don't all go down together when the news turns bad. Let me break this down the way I would if you were sitting in my office, not as a client, but as someone I actually wanted to see succeed. First, equities, stocks. You still need to own them because over time, owning productive businesses is the only proven way to build real wealth. but you have to be ruthlessly selective. You're not buying the market anymore. You're buying companies with genuine pricing power, businesses that can raise prices when costs go up without losing customers. Think about the difference between a utility company and a luxury handbag brand. When times get hard, people stop buying luxury handbags. They do not stop paying their electric bill. That's pricing power. You're also looking for companies with strong balance sheets, low debt, cash on hand, the ability to survive a year or two of tough conditions without having to beg banks for money. When credit tightens, and it will tighten, the companies with debt problems don't get rescued, they get destroyed. And if you own them, you go down with the ship. I've seen it happen 100 times. Good businesses, bad balance sheets, wiped out in a downturn while their stronger competitors bought their assets for pennies. Second, real assets. This is where a lot of beginners miss the boat because they think it's all about buying houses. Real assets are bigger than real estate. They're commodities, energy, metals, food. In a world where money printing is the only answer governments have to every problem, real things hold their value. The dollar can be printed infinitely. A barrel of oil cannot. A ton of copper cannot. A bushel of wheat cannot. This isn't about becoming a commodities trader. It's about understanding that these things are the new strategic reserves. Nations are stockpiling them. Companies are fighting for access to them. You don't have to own a tanker full of crude to get exposure. There are ways to participate, ways to own a piece of this shift without taking on the risk of futures contracts that can wipe you out in an afternoon. Third, international exposure, but not the way most people think. Don't just buy a fund labeled international stocks and assume you're covered. That's lazy. That's dangerous. You have to be selective. Where is capital flowing that is not directly tied to the conflict zones? There are pockets of stability in this world. There are economies that benefit from the fragmentation that become the new manufacturing hubs, the new energy suppliers, the new safe havens for capital fleeing instability. You have to look past the popular narratives. You have to read the annual reports, follow the capital flows, watch where the smart money is actually going, not where the headlines tell you it should go. I made a mistake back in 2016 that taught me something important. After the election that year, the market reaction was violent. It was immediate. It was terrifying if you only looked at the surface. Everyone panicked. Clients were calling, screaming, begging for someone to tell them what to do. I didn't panic, not because I knew the future. I didn't know who was going to win. I didn't know what policies would pass. What I knew was the fundamentals. I sat with my team and we asked the real questions. Were American businesses still fundamentally sound? Were their balance sheets intact? Was credit still flowing to the companies that deserved it? The answers were yes. The structure was still there, even if the headlines were chaos. So we didn't react to the noise. We stuck to the process. And when the dust settled, the businesses that were sound before the panic were even stronger after it. That discipline, that ability to separate signal from noise is what you have to cultivate, not prediction. You will never be able to predict the next headline. Nobody can. Not me, not the people on TV, not the guy in the Facebook group who claims he called the last crash. Prediction is a fool's game. Preparation is the game of winners. You now have the framework. You understand what's breaking and why. You know what a fortress looks like. You know what to avoid. But here's the hard truth. Knowing it and doing it are two completely different things. In 1 month, we could have a completely different set of headlines. A peace deal here, a provocation there, a crazy tweet, a central bank surprise. The volatility is not ending. It's just beginning. We are entering a decade of volatility, not a season of it. And the single biggest factor that will determine your financial success over that decade is sitting about 2 feet behind your eyes. It is your ability to control your emotions when everyone around you is losing theirs. Beginners want excitement. They want the rush. They want to feel like they're in the game, making moves, being alive. Pros want boring. They want portfolios they can forget about for 6 months while they live their lives. If you are just starting, if you're still finding your way, aim for boring. Aim for a portfolio you can ignore while you learn. The goal right now is not to get rich overnight. The goal is to still be in the game when the crisis passes. Because it will pass. It always does. Every crisis in history, every panic, every crash, every world war, every pandemic, every bubble bursting, they all passed. And the people who kept their heads, who preserved their capital, who methodically invested in quality during the chaos, they were the ones who benefited from the recovery. Not the people who panicked and sold. Not the people who chased the hot tip. The people who stayed grounded. This is what I want you to take away. Not a stock tip, not a promise, just a framework, a way of seeing. The world is changing. The old rules are being rewritten. You can fight that change and lose, or you can adapt and survive. The choice is yours, but you don't have to make it alone. That's why I'm here. That's why this channel exists. I'm Jamie Dimon. This has been Dimonomics. The world is shifting beneath our feet. Change with it. Don't fight it. Protect your downside, and the upside will take care of itself. Now go share this with someone you care about. Your brother who's worried about his 401k, your friend who just started trading and has no idea what he's doing, your parents who are retired and wondering if they're safe. They're probably just as confused as you were an hour ago. Help them see the signal in the noise. Help them build their fortress. And I'll see you in the next one.